Well, good morning, everybody, and thanks for joining us today. Welcome to the Centrepoint Alliance Investor Conference Call. All attendees are now in a listening mode. On the call today, we've got Centrepoint Alliance CEO Angus Benbow and CFO Brendan Glass. In a moment, I'll pass you across to management to kick off our discussion of the company's progress. But first, just to address some housekeeping. We'll have a formal presentation today followed by Q&A. If you want to ask a question during the call, please type it in the Q&A panel, which is within your Zoom app. Alternatively, for everybody who's dialed in using their phone, you can email any questions to tim@wicommunications.com.au and we can address them that way. So to kick things off, I'll hand over now to Centrepoint Alliance CEO Angus Benbow. Go ahead, Angus.
Thank you, Tim, and welcome everybody to Centrepoint Alliance's first half results for the 2021 financial year. I'm Angus Benbow, Chief Executive Officer, joined by Brendan Glass, Chief Financial Officer, and looking forward to taking you through our results today. We're proud to deliver continued improvements in revenue and profitability in the first half of the 2021 financial year. The three-year transformation that we commenced during the first half of 2019 financial year has allowed us to improve the company's operating performance and position us to seek new strategic opportunities. We enter 2021 placed strongly to drive continued growth and value for our investors and our community with a scalable business model, attractive service platform for advisors, and a simple and clean balance sheet with strong cash balance that has allowed us to resume dividend payments. We retain a clear focus on our objectives to enhance value in the second half of this financial year as we drive aggressive organic growth in the licensed and self-licensed market, leverage our scale advantage with advisor technology, investments and extensions, and actively pursue consolidation opportunities. From a financial perspective, we've seen a 15% increase on the first half of 2020 to our gross revenue to 70.6 million, which has enabled that turnaround in EBITDA, excluding legacy claims, to 2.1 million, which is an increase of 1.8 million compared to the first half of the 2020 financial year, enabling a strong cash balance closing position at 31st December of 14.7 million, which is up 107% for the first half of 2020. This has enabled us to distribute a fully franked dividend paid today, 26th of February, of a 3-cent special and a 1-cent ordinary, resuming the interim ordinary dividend. Core business transformation is on track. We've seen a 109% increase in our underlying AR revenue, so that recurring revenue stream, since the first half of the 2019 financial year. Continuing to explore and pursue new opportunities with success with our dealer-to-dealer wholesale service market, with another major contract signed in the first half, and continued focus on revenue extensions and new growth, especially through technology, with the completion of the integration of Inzumo, and looking to explore and extend that even further. Centrepoint Alliance has a strong national geographic footprint with significant presence on the eastern seaboard. This provides for scale advantage delivered to our community advisors, and we can leverage this scale advantage through things such as the delivery of training, technical support, and the rolling out of things such as advice technology solutions to a broader subset of advisors and firms across either the self-licensed, our licensed market, but increasingly also the wholesale market as well. Now I'd like to go into the financial results, and in doing so, hand over to Brendan Glass to go through in detail our results today.
Thank you, Angus. Good morning. Our financial results summary showcases the strong performance of our financials in this reporting period. Our gross revenue was up 15% on PCP, or $9.1 million. Our gross profit was up 10% on PCP, and our management expenses were down 3% on PCP, or 10% excluding Inzumo acquisition. This was underpinned by higher advice fees, a seamless integration of Inzumo, which was acquired in June 2020, and partially offset by rebate runoffs, which we anticipated. Our cost to income ratio is down to 86%, and that has been consistently delivered month on month in this reporting period. Our EBITDA, excluding legacy claims of 2.1 million, is up 1.8 on PCP, and our profit before tax of 1.2 million is up 2.4 on PCP. And this is due to EBITDA growth, management fee savings, and importantly, nominal claims expenses of just 17,000 for the period. Now, looking at our revenue and expense analysis in some more detail, you can see from the waterfall chart that on the back of advisor acquisition, the final fee step up in July 2020, we had advisor fee growth of 2.3 million. This has comfortably offset the rebates of $2 million, which we anticipated to run off. Our investment margin is down slightly at 300,000, and that is driven by pricing pressure as well as some nominal outflows. You can see from the waterfall chart that the $14.1 to $15.5 million increase is principally driven by Inzumo, and that's on the back of leveraging our consistent and ongoing relationships with our clients, as well as growth from our Inzumo sales team and leveraging the Centrepoint Alliance brands. In relation to our expense movement, excluding the impact of Inzumo, our expenses are down 1.4 or 10%, and that's mainly driven by employment costs being down by 900,000 or 10%. You can see that our FTE count is down from 107.5 to 90.6, and it's important to note that in the full year last year, our employment costs savings were 1.1 for the full year. So 900,000 in saving for the first half is leveraging that headcount reduction from the second half of last financial year and ongoing financial discipline. Our professional fees are down 400,000 or 30%, and that was due to lower reliance on consulting fees, external support, and doing less with more. We also derive savings from our auditor transition. Our travel and marketing costs are down 300,000, 52%, principally driven by the lower spend which we were unable to enact because of the COVID restrictions. And as you can see with the waterfall chart, the major driver of that expense in terms of an increase is the $1 million of Inzumo from our valued 8.7 FTEs, which we brought into the business. In terms of our balance sheet, as Angus mentioned, our cash position at the end of December was strong at 14.7. That was derived from $2.5 million in NEOS life repayments. Our cash from operations was up 1.8 on PCP, and that was somewhat offset by claim settlements of 900,000 for the first half. Our reduction in claims provision, importantly, is driven by principally legacy settlements, which relate to the extended claims for the extended AFCA window, which went out to June 2020 last year. As I mentioned, we've only incurred 17,000 in expenses, and we remain comfortable with our provision for legacy claims. Our net assets have increased due to net profit after tax generated and some timing benefits of working capital, which are prepayments. Now, looking at our capital management over the calendar year for 2020, you can see that strong growth from 7.1 12 months ago to 14.7. And stepping through that, we leveraged the onset of COVID to the tune of $1.5 million. We derived $4.2 million for the last 12 months in NEOS loan repayments, including an early repayment, which we negotiated at the end of last year. On the back of two strong performances in our last two halves, we've derived $5.3 million in net cash flow from operations. Our claim settlements for the 12 months, which is a settlement of provisions on our balance sheet, is 1.8, being 900,000 for both halves. The Inzumo acquisition was a cost to the group of $1.2 million, net of cash acquired, and we also outlaid 400,000 for our share buyback scheme. So on the back of significant input from our net cash from operations and the early derivation of NEOS loan repayments, as Angus mentioned, the group declared a dividend in early February, which is paid today. The outflow for that is $5.8 million. Subsequent to those dividends being distributed, we still have a very valuable franking credit balance of $15 million. In relation to the deferred COVID tax payments, which I mentioned, they are fully settled and scheduled to be fully settled by August 2021. And in relation to our recent share price appreciation and leveraging our balance sheet flexibility, which includes no debt, we continue to actively pursue consolidation and strategic opportunities. I'll now pass over to you, Angus, for the business update.
Thank you, Brendan. Now just moving on to our business update and strategic outlook. We've entered the third and final year of our strategic refresh, And over those 3 years, we've transformed the core business model to move the business to have a sustainable revenue model, recurring revenue model. We're seeing that through that 17% increase in our gross revenue since the first half of 2019, that 70.6 million just talked about. This has been underpinned as well by 109% increase in the underlying AR revenue since the first half of 2019. This is the fees that we charge to advisors moving away from legacy rebate arrangements. So the core business model and revenue model has been transformed. This is at a time that we've transformed the core service offering that we take to advisors. We're particularly proud of how we've done this in an incredibly cost-efficient way with a limited use of capital to draw down on. And that's demonstrated through that expense reduction of the last couple of years. 13.8 first half of 2019, 12.5 that we see there first 21 year. We've done that through, as I said, disciplined execution, but also a realignment of staff to the front line around services valued by advisors, and it's been underpinned through a lot of technology as well, hence why those efficiencies are flowing through. This has delivered, obviously, been managed from a capital discipline perspective very effectively, which is highlighted through the cash results that are coming through there. The first half, 7.4 of 2019, growing to 14.7 the first half of 2021 at the end of December that we've got. This is at a time that the industry has gone through a once in a generational change. So to manage that transformation with a solid cash position with no debt, I think is a credit to the business and the commitment of our advisors. Moving on to our advisors, the best measure of success is our advisors joining the Centrepoint Alliance community. We've had 27 new joiners in the first half of 2021 year, which is consistent with prior periods. Obviously, the wholesale opportunity is slightly different, which we talked about, and I'll go into more detail. But in terms of underlying organic growth, we're in line with prior years. Particularly pleasing there, you can see organic growth of 8, which is not a lot, but that's actually 8 new recruits to the underlying advice practices as part of our network, which they're growing. And that's also reflected in the quality of the advisors that are joining the business, with a doubling of the revenue of the new firms coming in as opposed to those ones that are exiting. On exits, we do still see some leakage. That's predominantly as a result of the industry shrinking and that generational change that's playing through. So we've had 9 ARs, advisors cease as ARs, just handing their AR status in, and we've had 24 exit, with most of those either downsizing firms or moving to their own AFSL. We've had minimal advisors or firms moving to other competitors, which are advisors who are committed to staying in the industry, have profitable businesses, are very attracted to the Centrepoint Alliance offering with high retention. The hard work of transforming the core business is complete. There's obviously always more work to do, and we're increasingly leveraging technology and the scale of what we've built out, especially with the Inzuma acquisition. We do have a new scalable service platform that I've talked about that our advisors value, and that the technology is increasingly being used to leverage that. We see that that's going to be increasingly beneficial for the Centrepoint Group as the industry consolidates. We do feel that the consolidation will accelerate over the next 12 to 18 months or 24 months for a variety of factors. If we look at the chart in the middle, we've got, this is for licensees of greater than 10 ARs across the industry. That's remained relatively consistent, yet we've seen a significant contraction in the amount of advisors in the industry as people have exited. So the market is contracting. We've got increasing costs that have been well publicised in terms of licensing costs, professional indemnity insurance, technology costs, and increasing competition. So we see it's likely that the consolidation will continue or accelerate, and we believe the Centrepoint Alliance is very well positioned to take advantage of that consolidation. One particular segment that I'd like to highlight is the wholesale licensing opportunity. Talked about this in the highlights. Wholesale licensing opportunities, effectively where we as Centrepoint Alliance can pass on the benefits of our scale investment and service platform to licensees that are subscale. What this does, it means that those community of advisors continue to prosper, and there are some really great businesses in that 30 to 100 ARs, yet they don't have the scale to probably continue to operate with the rising costs. So we see that as an opportunity for someone like Centrepoint Alliance, who invested in that scalable platform and can actually take advantage of taking that out to other licensees, not just to advice practices themselves. We've already had success with this, with two significant contracts being signed over the last 12 months and increasing opportunities coming to the group. It's a significant opportunity for us that we're excited to pursue. It's important to hold ourselves accountable to our execution roadmap. These are our 12-month strategic initiatives that I went through in the full year results at the end of last financial year. It's effectively our execution scorecard on strategic initiatives, as I said. And we've seen continued strong and disciplined execution. And it is what has underpinned the transformation in the core business, the fact that we've been able to attract and retain quality advisors, our investment and forward thinking around advice technology over 3 years, and ultimately what has delivered the turnaround into financial results and enabling the redistribution of dividends fully franked today. I'd like to highlight 2 areas of these strategic initiatives, which I think paints a picture of the opportunities in front of us. The first is what is it, this scalable service platform we talk about, and why is it important to us? And the second is our technology investments and delivery. So from a scalability perspective, we deliver services to advisors around the country, as I've talked about. Over the last 6 months, we have invested in the systems that we service our advisors through the use of extension of Salesforce, for instance. And in the October to December quarter, we had 8,000 inquiries from our advisors, on average 2 inquiries per advisor per week, and we're resolving those. I think 92% of those were resolved in 2 days. So that's the level of sort of service and data or services that we provide. Why is that important? And I guess this is a retail terminology, but things like Net Promoter Score or NPS that you are all very familiar with is the reason that these sort of things are really important to us. We're a service business. We provide services to advisors who are small business owners who need rapid resolution so they can get back and focus on their clients. And that's what we hold ourselves accountable to. And with this level of data, it's also what we can demonstrate to our advisors that we are committed to them, and it's a key proof point in attracting new advisors. So through that rapid resolution, we have high advisor satisfaction. When we measured that last year, 83% of advisors in the Centrepoint Alliance network were satisfied. And you can see how that satisfaction overlays on the resolution and response time by specific teams. And that leads to growth, obviously. It's very good to be able to go out to advisors and demonstrate what we can do for them, and that we hold ourselves accountable to that. But it's also the high retention, with that average licensed advisor being with the group for 11 years. So it's effectively an advisor retention wheel, which leads to that subscription-like recurring revenue. On the technology roadmap, we have talked in the past about our investments in Centrepoint AI, data, Centrepoint Connect, the Inzumo acquisition, but it's not until you step back and look at that on one slide, I guess, around what we've done over the last 3 years that really illustrates the commitment to forward thinking and advice technology that we've had in the business. I think given the amount of change that we've experienced and rebuilding the revenue model, focused on advisors and the delivery of these technology solutions, sometimes it can get a bit lost. I think it's really exciting to be able to highlight that we've got over 20 staff, or approximately 20 staff in advice technology teams alone, which provides great opportunities as we look out, and that includes the Inzumo staff, to leverage the internal data platform that we've built, to leverage the partnerships with all the people below the line that you see there, in terms of integrating their offerings with our offerings, to take new and exciting opportunities out to the advice community. They're looking at ways to deliver advice in different ways. They're looking at ways to leverage data, leverage digitization, automation, and that's the role of the licensee, to help actually take out solutions at scale. And we've built out that capability to really start to explore that in new and different ways, which we're excited about. One example specifically of that is our recent partnership with IntelliFlow. IntelliFlow is the market-leading software advice technology software provider in the United Kingdom. They've recently, or in the last 2 years, been acquired by Invesco. So they're backed by obviously a very significant investment partner there, and Australia is the first new market that they want to enter out of the UK. They've partnered with Centrepoint Alliance and Inzumo. Inzumo is their implementation partner and piloting with a number of Centrepoint Alliance practices with a market entry later this calendar year. The reason why we've been able to attract somebody like IntelliFlow to this partnership is through our scale, through our demonstrated commitment to advice technology, and also the fact that we've completely rebuilt our own proposition around data and technology, which supports the IntelliFlow model. This is an exciting partnership that we look to take advantage of over the next 12 to 18 months. Not a detailed slide, but important. The importance of the detail is our focus. So we have 4 segments that we're very focused on, and these segments were called out in the full year results last year and the half year results 12 months ago. But today we're sort of providing, well, what does that Centrepoint ambition look like? So our licensee market, so this is where we're focused on licensed advisors joining our license. We currently have 308. We'd like our ambition to be in 2 to 3 years' time, 500 advisors on our licenses, and that's going through organic or inorganically. On a self-licensed side, currently have 149 firms, about 800 advisors, growing this out to 250 firms, which would give well over 1,000 advisors, would be the ambition that we hold ourselves to. And in the wholesale licensee market, whilst moving from 2 to 15 doesn't feel material, these are very long-term contracts with annuity type revenue streams. We're building deep partnerships, and that would be a 20% penetration for that market. And we've already had 2 signed, so continuing to explore that. So what does that mean for upside in terms of, what else does that mean we can do? Well, if that comes through the revenue extensions. With that size business in 2 to 3 years' time, it effectively builds an ecosystem or a platform of over 600 firms and well over 2,000 advisors that we can extend revenue opportunities into. The type of revenue extensions will be around technology solutions, other business services. And this is an area that we've actually already doing work in. This has grown out organically in a sense that already today we have 70 firms and about 90 advisors who are utilising Centrepoint Alliance's, third-party sources around outsourced workforce sources. The largest cost to advisors is staff. So we provide, third-party relationships to outsource power planning administration services. And we've actually seen this grow by double the amount of firms using that offering just in the last 12 months. So we would like to extend that deeply to at least 120, probably more firms, but in a much deeper way in terms of the opportunity set. So in summary, got a very clear focus for the second half of the financial year, capitalising on the last 3 years of the transformation to continue our market leadership position in the provision of quality advice and business services. Doing this and driving aggressive organic and growth in the licensed and self-licensed market, increasingly taking advantage of our scale advantage and taking advantage of our investments in technology and extensions and exploring new opportunities. As Brendan said, from here it's about pursuing consolidation opportunities to create value. And do this because we've got a very flexible balance sheet and we've had strong share price appreciation. So we're excited by the opportunities we're seeing and continue to pursue. I'll leave it there. I think that wraps us up for the presentation. See contact details there, but we will open and pass back over to Tim for any questions that have come through.
Thanks, Angus. Thanks, Brendan. We have had a few questions come through, so any attendees who have further questions for management, please post them into the Q&A panel on the Zoom screen and address them that way. First question, Angus, is this: great results, and I'm sure shareholders are pleased with the franked dividend. What drove the amount? Was it constrained by the requirement to retain a certain amount of cash or other factors? If cash constrained, why was a DFT not considered? And why the use of share buyback mechanism when domestic holders would benefit more from a higher franked dividend?
Sorry, Tim, unfortunately you were breaking up through that.
It's a multi-part
just gonna read
dividend question, Angus.
Pardon?
Should we take it bit by bit? The first part was what drove the amount of the dividend. Was it constrained by the requirement to retain a certain amount of cash or other factors?
Look, we do retain a certain amount of regulatory capital that we have to maintain and working capital. And as Brendan went through as well, we still have some tax deferral credits that we have to pay back. But we felt it was striking the right balance in terms of the retention of cash, the distribution of the fully franked dividend, given that we've seen significant inorganic opportunities in the market as well. So it is providing a balance around capital flexibility to continue to pursue opportunities for growth at a time that the industry is very much, we believe, the consolidation will accelerate. So I guess there wasn't a constraint there. It was a balance of maintaining a posture for growth, utilising effective capital management around the fully franked dividends, but also maintaining obviously reg capital and things like that.
And just to add to that, that certainly doesn't constrain us in terms of growth aspirations. We don't have any debt on the balance sheet. We have access to debt if we wish to take access to that, as well as other capital injections. So at that point in time, dividend appropriation was made, but we still focused on our growth aspirations.
Thanks, gents. And just the follow-up to that one was, why was the dividend reinvestment plan not included, and why the use of the share buyback mechanism when domestic holders would benefit more from a higher franked dividend?
The share buyback mechanism was something that was put in place 12 months ago at a time when the share price was at a very different place. And the group felt that at the time, and I think it's played out, that that was an effective use of capital for our shareholders.
Thanks, gents. Another question that's come in regarding legacy claims. Can you talk to the outlook for legacy claims, and do you have a view on when the provision for that will cease?
I'll take this one, Brett.
Look, we had a number of material legacy claims on the balance sheet last year, and as I mentioned in my presentation, we have all the settlements for claims in this first half were in relation to prior provisions and specific provisions. So we successfully negotiated through those, and we haven't incurred any new legal expenses, any new claims expenses for this financial year. So as we know with this industry, you can never draw a line in the sand with this, but in relation to our $2.1 million balance, we're very comfortable that that's providing for our claims at this point that are known.
Thanks, Brendan. Another question that's come in says, great result. Operating costs have typically been higher in the first half than the second half. Will this trend continue in the second half of financial 21?
Yeah, so that if you look back on the results over the last 12 to 18 months, the first half of the last financial year, the operating costs were higher, but that's where we're getting the full year benefit of that playing through. And that's what Brendan talked about. Last financial year, there was a 1.1 million reduction in our, I think, employee expenses for the full year as a result of actions we took last November, December, and that's flowed through. Obviously, we're getting the full year benefit of that at the moment, but that means we're pretty consistent this year in terms of half on half. Okay.
Yeah, I mean, subject to ongoing aspirations around our top line. So that's something that is a swing factor within our forecast.
Thanks, gents. Just regarding advisor movements, you referenced new advisors in the Prezzo. Can you talk to where they came from and how do you see the trend of advisor movements looking forward?
Yeah. What I would say in terms of over the last 2 years, with the corporate activity from the big six, or what were the big six, we did see that drive a significant advisor movement across the industry. We didn't see that to the same degree in the first half of this year. What happened with the MLC and IWF acquisition is very different to what happened with BT or Westpac moving out of advice and CFS moving advice, whereas effectively out of advice, where effectively they close down their licenses and those advisors need to find a new. So in the first half, the advisor movement has been much more competitive in terms of advisor acquisition. That's why it's quite pleasing to see, on a prior comparable period, the half-on-half comparison is favourable. So they come from a whole variety of areas. Some of our mid-tier competitors, some other smaller firms that closed. I think we got a number out of one of the industry super funds that closed its advice division. So a whole range of areas. We obviously remain very active in the market from a organic growth perspective. In terms of going forward, we do see it increasing in terms of the competition, but it's also what advisors are increasingly looking for is value for money in terms of they are small business owners. They need a lot of support. Regulatory costs are going up. Advice technology costs are going up. And, it's harder for them to do business. So in terms of licensees who've invested in their services, and if they have, they're willing to pay the fees. There are still quite a number of licensees out there. I'd say more on the private side that fees are very low, and that makes some of the pricing pressure quite tough. But one of the things that I say to advisors when we're out recruiting is that we're looking not to recruit advisors, we're looking to recruit and business owners and people who view their business as a business. And because of that, they value the services that we provide and the fees that they pay us. So we continue to pursue that. In terms of leakage, we did see quite a few advisors leave over the last 2 years as we stepped up that fee increase, but that's also a result of the industry going through that transformation. What's really pleasing is that we've actually been able to replace those advisors with new recruits, and that's where we see the average revenue of advisors doubling in terms of coming through, and would expect that to continue.
Thanks, Angus. Just back on dividends, are you able to clarify the dividend policy from here going forward? And are you able to provide any further insight into the decision-making process to not implement the dividend reinvestment plan, just with regard to the franking balance on the balance sheet?
In terms of, I'll take the dividend policy one. Obviously, there's demonstration of the strong capital position that we sit in, was the redistribution of, or the special dividend, but also the moving back to an interim ordinary dividend around the confidence in the underlying business. In terms of an update to dividend policy, that there's no formal update for the dividend policy. I think the group is committed to managing very capital management discipline and returning that value to shareholders, and hence why we've indicated a return to interim ordinary dividends. But as I've talked about a lot, there are a lot of growth and consolidation opportunities in the market as well. So it's also about maintaining that capital flexibility. In terms of dividend reinvestment.
Thanks, Angus.
Yeah. I mean, that's something that was discussed with the board and is an ongoing consideration. At the time, it was decided not to proceed with that for this particular iteration.
Thanks. Another question that's come in just on capital management. After paying the dividend and repaying the tax and paying the claims forecast of $2 million, how much cash do you expect to see left on the balance sheet? So
the cash at the moment after the dividend is paid out today and less the cash in escrow for the tax payments, is that the question?
I think that's the question, yeah.
Okay, so that's 14.7 less 5.8 and 187.3, so around 7.5 million. So sort of taking us back to 12 months ago in terms of where our cash position was.
Thanks, Brendan. Just remind everyone, submit your questions through the panel if you've got them for management, and we'll address them. Just one more question we've got here. After integrating in Zumo, do you see further M&A type transactions on the horizon?
Look, we've continued to be, the market, there's a lot of opportunity in the market on the dealer group or licensee side, but also around revenue extensions. And the Inzumo acquisition was a very strategic one for us. It's great capability at good value, and it's a great extension. So we continue to explore opportunities in the market. And I think what we've done, if we see an opportunity to pursue that, and there's been accretive for us, but also not to pursue opportunities where we feel they're expensive or don't align to the core business, and we'll continue to do that.
Yeah, I guess, and just managing through transformation as well as an integration, it's always really important, integration post-acquisition. I mean, the acquisition, the integration is more difficult than cutting a check. So we've really focused on a seamless integration, as I mentioned, immediately accretive. So we build further confidence on the back of that.
Thanks, Brendan. Thanks, Angus. That concludes all the questions that we've had come in from attendees today. So really want to thank everybody for your interest in the company. Really appreciate your support. We're looking forward to reporting our progress and looking forward to the opportunity to talk to you all again. So Angus and Brendan, I might pass across to you now for any closing comments.
No closing comments. Just thank you to your support, to your interest in the Centrepoint Alliance business. Also acknowledge, and as I did earlier today, to our staff, and past and present, the last 3 years has been a challenging one for the industry, but what we've achieved at Centrepoint Alliance through the strategic execution, which is flowing through the financial results now, I'm incredibly proud of. But it's not been myself or the executive team or the board, it's actually been all our staff around the country, but also the commitment of our advisors as well to come on that journey with us. In terms of, for many of those businesses, we doubled their fees over the course of 12 months, and they stayed in the business and stayed part of the network. So it's a broader effort, and I think the results are playing through now. So just an acknowledgement of that. That's it. Thank you, Tim.
Thanks very much, everyone.
Thanks, Tim.
Thanks, Angus. Thanks, Brendan. We'll chat to you again soon. Cheers. Bye.